Hey everyone. We are going to have some fun today. Got another Ask Adam, and going to spend about 45 minutes going through some of the questions I have from some of the smartest clients in the world. So I also got about 50 or so questions through email that I also will get to, hopefully. I'm going to try to do this once every 3 or 4 weeks. And guys, try to challenge me. I'm up for the challenge. You know, this is my passion. This is what I love to do. So I want some tough questions. Try to get me. And if I don't know the answer, I'll tell you, and I'll research it, and I'll get back to you, because getting you guys the right questions, right answers to the right questions, educating you, that's what I want to do. We all have the potential to be millionaires at retirement. The system is literally rigged in our favor. We're all in anticipation. We all potentially have a golden lottery ticket. All we need to do is just cash it in, right? The retirement system works, whether you're a Democrat, Republican, no matter your religion, your ethnicity, this thing works. It's based off simple math, tax deferral, compounded interest. Your money grows faster without tax. Unfortunately, about 60% of Americans have retirement accounts. So we got some work to do. But for all you guys on the YouTube live, you guys are the smart ones, and congratulations. You guys are going to have lots of money at retirement. Fortunately, that wealth gap is going to increase. And the people that aren't educated, all our fellow Americans, 40% at least, are going to be left behind. And it's too bad, because the system is literally rigged in our favor. We all have a golden lottery ticket. So let's get right to it. Okay. The first question is, Scott, I'm 65 years old. I purchased a property for my self-directed IRA. You helped me. Great. I love you, Scott. I now rent it out, but want to use it about 5 or 7 years. Okay. So, Scott, you can do it. You're over 59 and a half, assuming this is a pre-tax IRA. You need to get a valuation in 5 to 7 years when you want to use the property, and you're going to pay tax on the fair market value of the property on the date you want to use it. Now, if you had a Roth IRA, then if you're over 59 and a half, which you are, and the Roth's been open at least 5 years, bang, tax-free. Who cares what the value is? You could have bought it for 300 grand, could be worth 5 million. It's all tax-free. So that's the main distinction, obviously, by owning assets in a pre-tax IRA or a Roth IRA. So, Scott, to answer your question, yeah, just need a value, and you can do whatever you want with it. He also asked, can I take it as an RMD and pay it off a little each year? So you can't do an RMD. You can do an RMD of land, for example, if you want to take the land. If it's a house, clearly you can't just take the bathroom. Now, if you own the asset in an LLC, could you take a portion of the LLC each year? The issue, it's a little risky because, for example, let's say 100% of the LLC is owned by an IRA. Okay, now you want to take 3% and own it personally. So now you have a situation where your LLC is owned 97.3 between you and your retirement account. Number one, you got to file a partnership return. Number two, are you dealing with a prohibited transaction situation? Because now you have a situation where the assets owned pro rata between you and your retirement account. I wish I had a clear answer. There's zero guidance on the IRS on that. I've had some clients do it, but just be cautious, because potentially the IRS could try to argue that if you do it that way, where you take the LLC interest as a distribution over time, you could run into the prohibited transaction world. So it's a great question, Scott. I hope it was a good answer. Next question is from Grant. Hello. Ethereum staking has gone live on platforms like Kraken, Coinbase. Can I receive interest payments with funds from my IRA? Yeah, you could. Interest is not subject to unrelated business taxable income. Unrelated business taxable income is a tax imposed on retirement accounts and charities. But in our case, we care about retirement accounts that engage in 3 types of activities. 1, margin to buy stock. Okay. And the loan has to be a non-recourse loan. 2, use a non-recourse loan to buy real estate. Not the situation. 3, you invest in an active trader business, like a restaurant, through a pass-through entity. Here, you're receiving interest. Interest is not subject to UBTI. Rental income is not subject to UBTI. Capital gains is not subject to UBTI. Dividends not subject to UBTI. Same with royalties. So in your case, Ethereum, you're good if you want to work with companies that will provide you any type of returns for lending out your cryptos, you can do it. Okay, the interest will be not subject to UBIT. Just be cautious, obviously, because it's not secured or licensed. So if there are companies, even Gemini, that's doing that. There is no security as to what happens to those Bitcoins. So companies are paying 5-6% to borrow your Bitcoin. Yes, there's a market behind that. There's ways for them to make money on that asset, but it's not secured. So just remember that. Another one for Scott. Man, Scott, you're good. How is RMD calculated? So RMD is based on value, right? So you just take your value as a 1231 of your IRA, and you plug in a formula. If you're a client of the trust company, which you are, we will give you the RMD number and you'll pay tax on that amount. Next question. When I convert a Roth 401k to a Roth IRA, do contribution gains transfer over with a contributions? So if you do a rollover of a Roth 401k, so assuming you're over 59 and a half, you close your plan and you move the Roth 401k to a Roth IRA, that's a tax-free rollover. That is not subject to tax. That's not considered a contribution. Contributions, when you put money from your pocket and contribute it to an IRA or 401k, right? The contribution maximum for 21 is $6,000 in an IRA, $7,000 if you're over 50. In a 401k, it's $58,000, $64,500 if you're over 50. This is a rollover. It's tax-free. You can do it so long as you are over the age of 59 and a half, or you close your plan or terminate your plan. You will be able to do that. Hi, Adam. Dumb question. Well, there's no dumb questions. First thing they teach you in law school, ask any question. Nothing's dumb. I would like to contribute to my 401k throughout the year. Should I send the funds to my custodian who transfers the funds to my business checking account? So the way it works is contributions need to go from either you as an employee. You can do $19,500, $26,000 if you're over 50. And if you're sole proprietor, essentially that can go from your personal account or your business account. And that's going to transfer to a separate account in the name of the 401k. So if you are a client of IRA Financial, you'll have your own plan bank account with a tax ID number where you can make the contribution of those assets from your business to the new 401k. Now, if you're doing employer contributions, those need to come from the business. Those are tax deductible. So I would send them directly to the 401k, whether it's through us or whether you have it at a local bank. And then the 401k should not transfer it back to the business because that could be a prohibited transaction. 401k should then invest it, whether it's stocks, mutual funds, ETFs, real estate, Bitcoin, whatever it is. The 401k needs to make the investment. The funds need to go from you or your business to the 401k, and then the 401k needs to invest. So just keep that in mind. Pros, cons, complications. It's the next question of doing a backdoor IRA to Roth and then using the backdoor to a self-directed IRA. It's Jay. Good question. I do backdoor Roths. I don't think there's any potential negatives. The only thing to keep in mind is aggregation. A lot of people don't realize that if you do a backdoor Roth and you have other IRAs from prior years, you need to aggregate all your IRAs to determine how much can be converted to Roth. For example, let's say you had a $5,000 IRA from 2015, and now it's 2021. You make over $208,000, married, file jointly, and you want to do a backdoor. How do you do it? Well, you open a regular IRA account, right? It's just after tax. It's a traditional IRA. Just don't take that tax deduction because you're not allowed to. You make the contribution. But then if you have other IRAs, you need to aggregate them. So take the $5,000 IRA from 2015 in our example, add it to the one you want to do now, another 5. That's 10. So you want to now do a backdoor of 5, which is 50% of 10. So only 50% of the $5,000 contribution you just did in after tax will be considered Roth or $2,500. If you had no prior IRAs, then whatever you do backdoor up to $6,000 or $7,000 in an IRA, that can go Roth tax-free and you don't have to worry about attribution. Prior to 2010, you could not do backdoors because there were income limitations on conversions. But guess what? The IRS got smart and they realized they love conversions. Why? You pay tax, and IRS loves when you pay tax. So they will encourage you to do conversions. And actually, I'm pretty surprised that the CARES Act or any future stimulus acts that have been passed during COVID did not include a similar provision to what was included in the 08/09 financial crisis, where they incentivized people to do conversions by allowing you to pay the tax over 2 years. So I'm actually surprised that didn't happen, because that's a great way to generate more taxable revenue. I don't know, maybe that will happen at some point, but it hasn't happened as of today. Hello, Adam. This is from Norway. If I start my YouTube and does not make any money for first 2 years, can I invest in SEP or solo? So, okay, this is probably a question about who's eligible for a SEP IRA or solo 401k. Great question. The IRS is clear. You need to have a business, and you can have no full-time employees other than yourself, another fellow owner, or the spouse of an owner or owners. The business does not have to be profitable, right? And I've said this before. It doesn't have to be the next YouTube or Google or Tesla. There just needs to be the anticipation of profit. Now, there's a demarcation line between business and hobby, right? If you are seeking and have the anticipation of generating revenue, you're developing software, or developing a consulting business, or developing a technology business, it's understood that you may not have revenues in the first few years. But if you don't have legitimate expenses, if there's no anticipation of revenues, if after 3, 4, 5 years, there's still no revenues, there is a chance the IRS could argue that this is a hobby, and thus not a business, and hence you're not eligible to do a 401k. So you want to make sure you got a legit business. It does not have to generate profit or even revenues in the first few years, but it should at some point. Or you may be considered a hobby and thus not eligible for a solo 401k. So just an FYI on that. Okay, I got a lot of questions. Let me jump around here. Let's go to, I have a solo 401k through my own S Corp, and I have a regular W-2 job with a separate 401k. Is my total contribution still capped at 19 annually? Yeah, this is a great question. So 402 is the section that talks about employee deferrals. The 402 limit is based off you individually. So if you work at Facebook and you also have your side business, you're going to be capped at the 19,500 or 26,000 if you're over 50. That is per individual, irrespective if you have 15 jobs or one job with a 401k, you're going to be subject to that 19,500 or 26 in the aggregate. So in your example, if you contribute 16,000 to the Facebook plan and you have a sole proprietor business selling something on Amazon, for example, you got another 3,500 if you're under 50, plus you can do a 20% profit sharing or 25% profit sharing if you have a C or S Corp based off your W-2. So the profit sharing is based on a business, okay? The employee deferral is under 402. It's based off you as an individual. So let's take that same example, right? You work at Facebook, put away 16 to their 401k, and you make $40,000 as a Schedule C selling, face masks on Amazon. Okay, so you can do out of that 40K Schedule C, you can do another 3,500 into your solo plan, assuming you're under 50, and then you can do approximately 20% of the 40, another 8 or so, into your solo K, right? So that would give you 16 in Facebook, and then 8 plus 3 in your little plan that's tied into your Amazon business. So to recap, employee deferrals are per individual, employer contributions are per plan. Now, if you own 2 or more businesses and you're under a control group, which means you own 80% or more of 2 or more businesses, or there's common ownership, or there's affiliation, you may be limited in terms of the amount you can contribute. Example, you got a restaurant and a bar, okay? You own 80% of both. One business has employees, the other business doesn't. Can you have 2 plans? No. You can only have one plan under the control group rules because the IRS considers it one plan. Even if it's 2 businesses, 2 unrelated businesses. It could be a restaurant and a bowling alley, a restaurant and a software company. Doesn't matter. If it's over 80% common ownership, from an IRS perspective, it's one plan. And they do that for good reason. They want to protect your employees. They want to make sure that what some people do, believe it or not, is they have a business. Let's say it's a restaurant. They got 30 employees. They say, hey, I'm a nice guy. I take care of my employees, but I really don't want to offer them 401k benefits. It's too expensive. I want to take care of myself, my spouse. So I'm just going to set up a side business, a little consulting business here. And I'm going to pay myself $100,000 through my consulting business. My employees will never know. How do they know I have a side business? I'll have a 401k through my side business, and I'll max out my 401k. And hey, my employees aren't going to know, so I'm good. No, the control group rules are there to protect your employees, to make sure you can't do that. So the IRS isn't that dumb. They got most of the stuff figured out for you. So if you think you have a workaround, call me, email me. I guarantee something in the tax code will probably persuade you not to do it. Okay, let's move around here. If Bob meets the definition of a fiduciary pursuant to 4975E2 as a result of managing Dave IRA, and Bob launches a hedge fund that Dave invests in by moving into the IRA, is that an issue? Well, potentially, right. If you're a fiduciary under 4975E2, you are definitely considered a disqualified person. Now, under 4975D, there are exemptions for certain financial advice. So you need to check out D to see if the financial advice is covered by an exemption that will allow you to do what you want to do with respect to your hedge fund. But in general, if you provide services to a plan, you provide any investment advice, you are deemed a fiduciary, and you may be limited in terms of your interaction with the retirement account or the amount you can invest. So just an FYI. Does taking a non-recourse loan and earn interest on the loan funds trigger UBTI? So yeah, if you do a non-recourse loan in an IRA, you're going to have UBTI, assuming there's over $1,000 of net income. Now, if you are lending out money, the interest you receive is not subject to UBTI. But if you're borrowing money in an IRA or 401k to do a deal, you will have UBTI tax. However, if you are using a solo 401k to buy real estate, and it's covered under the definition of real estate acquisition indebtedness, then there's an exemption under 514C9 that allows you to borrow money on a non-recourse basis and pay no UBTI tax. So just make sure you know what you're doing, what you're borrowing. If it's real estate related in an IRA, you're probably going to have UBTI if more than $1,000 in net income. Now, you are able to take into account depreciation, payment of loans, other expenses to hopefully reduce your net taxable income. But if it's over that $1,000, you could have UBTI. If you're doing real estate, you certainly want to consider the solo 401k, especially if you're doing leverage, because it's a really, really amazing exemption to get around the UBTI tax and kind of super leverage your returns. Why is a 401k pre-tax rollover to a Roth IRA tax-free? Should be a conversion. It's not. First of all, if you roll over a pre-tax 401k, it's got to go to a pre-tax IRA. If you move it to from a pre-tax 401k to a Roth IRA, Kevin, you're going to be subject to tax. Okay, guaranteed. Now, if it's an after-tax 401k or an after-tax IRA, then you convert it to Roth. That will not be subject to tax, assuming the after-tax IRA contributions did not earn anything. So going back to my $5,000 backdoor IRA question, let's say you made a $5,000 backdoor Roth IRA, or you made a $5,000 IRA contribution after tax on March 18th. March 19th, you convert it to Roth. If that $5,000 just stayed in the bank and didn't earn any returns, there's no earnings to tax. So you can then move it to a Roth because it's after tax. It will not be subject to tax. Although, if you had a pre-tax IRA and you want to convert it to Roth, all the amount you can convert, whatever it's $5,000, forget about earnings. The entire bucket of cash will be subject to tax. So to answer your question, yeah, you can't just move pre-tax to Roth and not pay tax. Oh, into a self-directed IRA that ultimately invests in Bob's hedge fund. Okay, this is moving on to a new question. If you have time, can you talk briefly about the ROB solution? Okay, the ROB's a rollover business startup solution, Robin, is the only legal way you can use your retirement funds to buy into a business that you or a disqualified person is personally involved in. Okay, it's typically used for like franchises. Generally, let's say, Robin, you got 100 grand in your 401k, former employer, you want to start a business, and you use some of that money to start the business. So if you did it in a self-directed IRA, we know under the prohibited transaction rules that you cannot use your retirement funds to invest in a business that you or your disqualified people, your lineal descendants, are personally involved in. That would trigger a prohibited transaction. Can't do that. So there is an exemption under 4975 D13 of the code that allows a C corporation to purchase qualifying employer securities. It allows a 401k to purchase C corporation stock, which is called qualifying employer securities. Now, this was stuck in the tax code in the early or mid 70s to allow an employee that works, let's say, GE or IBM to buy stock in the company they work for. That's called qualifying employer securities. Now, like almost everything else in the code, you get some smart people spending time analyzing provisions. They figured out that, hey, if someone who works at GE or IBM could use their 401k to buy stock in the company they work for, why couldn't it be used for a startup? Why couldn't Robin simply set up a C Corp? C Corp adopts a 401k. Robin rolls her former employer funds tax-free into the new 401k. 401k buys stock in the C Corp. Let's say Robin puts in 20 grand. 401k puts in 100. Okay. Stock is pro rata. It's owned by the 401k and Robin's personal bank account. And the money, that 120, is now in the corporation. Robin's 401k just bought qualifying employer securities, right? 4975 D13 said you can do it. And D are all the provisions that trumps C, the prohibited transaction provisions. So if you fit into a D, you get around C. So basically, a bunch of tax professionals, smart tax lawyers 30 years ago said, hey, let's do this. Let's find out how this works. And the IRS spent some time looking at this in the mid 2000s to late 2000s, about 12, 13 years ago. And they said, hey, this works. It's covered by D13. We don't love it because we think people are abusing it. They're not buying businesses. They're buying cars and driving around the country, just starting a business and pulling all the cash to salary. We don't love it. We think there's abuse, but if you do it well, you offer benefits to your employees. You use the money to buy business assets. Legal. Can't stop it. It's based off D13. They probably should have written D13 to pay, maybe limit it to public securities. That would have stopped Robs. But Robs has been around mainstream for about 30 years. Okay. The IRS, as I mentioned, has been well versed in this. They actually wrote a pretty lengthy IRS memorandum on this in 2008, basically saying, hey, there's tons of abuse, but not much we can do because it's legal. It satisfies D13. So if you want to use your retirement money to buy a business that you're going to be personally involved in, this is the best way to do it. It's the only legal way to do it. Now, one trick. If you need less than 50K, what I suggest, set up a business, adopt a 401k, roll, let's say 100K in, Robin, borrow the 50K, right? You can set up a 401k loan, borrow it. This way you don't need to set up a C Corp. You can do an LLC. You may have some flexibility. The loan is super cheap now. Interest rates as of March 2021 is just 3.25%. Easy, cheap money. And you're paying yourself back, right? The money's going back to your plan. So 3.25%, not a horrible return in today's world with interest rates like at zero. So it's a neat way to get some access to cash and use it for any purpose. But again, if you need more than the 50K, Robin, the Robs is going to be your solution. What considerations, if any, should be taken into account when moving from the state of self-directed IRA LLC and Corp to another state? So that's a great question, Rich. So if you set up an LLC, let's say in Texas, you own real estate in Texas, and now you're going to sell the property in Texas, you want to buy something in Michigan, you have two choices. You can keep that Texas LLC and just register to do business in Michigan as a foreign LLC. Costs anywhere from like 50 to a few $100. That's the easiest. Or you can just terminate your LLC and start a new one. Now, the issue with that is you got to pay fees to terminate an LLC. And if you have other assets in that LLC, it's a nightmare, okay? Because you're going to have to basically send that property, retitle it back to the trust company, IRA Financial Trust. Then we're going to have to quick claim it back to a new LLC. You're going to have all these additional costs, and it just, I don't think makes cost sense. Honestly, it just doesn't make financial sense. Most people, the way they do it, just keep your Texas LLC and file do business in a different state. Minor fees, generally the way to work. Now, the only one exception to that is California has an $800 minimum franchise fee. So if you were doing some real estate in California, now you sold that property, now you're going to do a new deal in Oregon or Maine, I'd probably terminate that LLC and just start a new one in a different state. But that's really only for California because of the high, annual franchise fees. It's really crazy. Okay, backdoor IRA, I did that. You know what I'm going to do? I'm going to jump into some of these email questions because I don't want to ignore some of these questions I got from some really smart people. So I'm just going to jump in on these. Can I have a traditional IRA and a Roth IRA account in one self-directed IRA LLC? Yes, you can set up an LLC wholly owned by a traditional IRA, a Roth IRA, a SEP, a 401k. It's just going to go pro rata. So let's say you put in 100 grand in a Roth, 100 grand in a traditional. The LLC is a partnership, 2 owners, 50-50 profits and losses. If the numbers were different, 80-20, 80,000 for the Roth, 20,000 pre-tax, just goes 80-20. Got to file a partnership return. Don't forget 1065 and also a state return and all cash distributions, income gains flow pro rata. So that's just something to keep in mind, but yes, you can do it. Can my spouse and I use one self-directed IRA LLC entity to make IRA investments? Yeah. Again, same idea. It's not technically disqualified when you do it together. So let's say you and your spouse each want to do 200 grand into an LLC to buy real estate. In those cases, I would do a one funding, fund it together. Under the Swanson case, the entity only becomes disqualified after funding. And at that point, I would not add any more money because you have disqualified people's IRAs. So I probably wouldn't do any additional contributions because you have family IRAs in there. But I would do the contributions simultaneously, and then profits and losses would go pro rata. Okay, what are the filing requirements for UBTI? So IRS Form 990T, which is actually due April 15th. Not sure if that's going to be extended now to May 17th. Going to wait on some guidance. You got to file 990T only if you have $1,000 more of UBTI. And again, that $1,000 is net of depreciation, net of payment of debt financing and other expenses. And again, you trigger UBTI only in 3 ways. 1 is margin on stock. 2, non-recourse loan, real estate in an IRA setting. 3, invest in an active trader business through a pass-through entity like an LLC. So that is the only the 3 ways you'll generally generate UBTI, 990T. You got to self-report that. Okay. Let's go. For an IRA LLC owned 100% by an IRA, when no funds are needed from the IRA for additional LLC investing, I assume this is done by creating more LLC membership units and selling them to the IRA. Well, when your IRA owns 100% of LLC, it's treated as a disregard entity for tax purposes. So generally, if you want to create additional funds, the safest way is to create new LLCs for additional funding. Technically, why your IRA is technically a disqualified person. So adding additional funds potentially could trigger a prohibited transaction under 4975C. However, our compliance department, our position essentially is if the IRA owns 100% of it and the ownership is going to stay at 100%, there's no personal benefit. We will allow IRAs to make additional contributions to single member LLCs. Off the record, we have spoken to the IRS on this, and they're not as concerned because they don't see any abuse. The IRA is still going to own 100% of the LLC even after the contribution. So that's something we would do. But again, if you got spouses in there, IRA from Jane, IRA from Jim, I would do a one-off contribution at the outset, and I wouldn't add any more funds to the LLC if you could avoid that. Let's see. Can a SEP be self-directed? Yeah, a SEP can be self-directed. So could a simple IRA. So could a 401k. So could a traditional IRA, Roth IRA, whatever you want. You can self-direct even a Coverdale health savings account. So you got tons of opportunities. If the IRS determines that a business was a hobby and not eligible for a solo K, but you already terminated the solo K and rolled over the investments to an IRA, what action would the IRS likely take? Well, I'm not sure. I mean, if they obviously what they would do is just invalidate your contributions, right? They'd probably say amend your return if you made contributions based off anything. Although the problem is there'd be no income, right? So there'd be nothing to amend. If there was no business income, probably nothing to amend. So would they argue those transactions are prohibited? I don't know. It's a good question. I don't think, generally I've been doing this, 13 plus years. The IRS doesn't want to invalidate your retirement accounts. It's really not something they're looking to do. They're pretty lenient on this stuff. Probably what they would tell you to do is honestly, don't set up the 401k again. Since you didn't make contributions, there was kind of no loss, right? Because you could have made the same investments in an IRA. So they didn't really lose anything. Couldn't make contributions because you had no income from your business. So they didn't lose any tax revenue. I think they probably would look back and say, well, in the future, make sure you have more of a business activity. I don't think they would invalidate your transactions. I really don't, because you could have done them in an IRA. Is purchasing an RV and renting it out on a shared platform like RV Share transactions allowed? So yeah, you can do it. RVs are allowed, right? It's not a prohibited transaction. So long as you're not living in it, you're not renting it out to a family member, RVs are allowed. The issue is an RV subject to UBIT? Is it deemed inventory? Does it generate rental income? Yeah, but isn't an RV immovable? That's the question. If you deem it to be immovable, then it's probably deemed rental real estate, and it will not be subject to UBTI and be tax deferred. If you would define it as something movable, and depending on the type of RV, then you're probably looking at UBIT. Now you can do it. It's not prohibited, but it could trigger the 37% tax. Just be aware of that situation. You want to try to argue that the asset that's generating the rental income is immovable, like a piece of property. If it's movable, like a car, then it's probably deemed inventory, not necessarily prohibited unless it's a collectible like an antique Corvette, but it could be triggered subject to the UBIT tax if it's deemed a movable asset. Okay. God. If we get a solo K for a side business generating 60 to 70K, spouse and me, can I still put 58K in after tax and roll over to a Roth? Yeah. So believe it or not, even if you have access to a 401k, the after tax isn't considered a 402. Okay. So the only thing is you just can't go above that 58 or 64.5, which is the 415 limit. So as long as you have enough income, you can do what's called a backdoor 401k, which is a really, really, really unbelievable tax strategy that not enough people know about. Now, if you guys subscribe to my channel, which you should do if you haven't already at IRA Financial, we post 5 videos a week, 3 podcasts, and I love doing videos on the backdoor Roth 401k. Why? Because it's such a secret, such a very important solution that not enough people know about. And based off the backdoor Roth, you can go dollar for dollar, 58 or 64.5 in 2021, and then convert it to Roth in the plan, or actually pull it out of the 401k, even without a triggering event, and go to a Roth IRA. So it's crazy. Like, let's take an example. Let's say you made 60K, okay, and you had a sole proprietor business under 50. You can do 19.5 in a regular solo K plus 20% of 60 or 12K, right? Giving you about 31.5. If you were smart enough, if you watch my channel or listen to my podcast, or you listen to watch and ask Adam, say, hey, I remember that guy, Adam, pretty smart guy, not maybe as smart as he thinks, but smart guy, told me about this backdoor Roth. And the way it works is I can go 58,000 dollar for dollar. So I made 60, let's say, dump 50K in, 58K. Then I can just roll it to an after-tax IRA, convert it to Roth. So now I have $58,000 in a Roth IRA or a Roth 401k if you wanted to leave it in the plan. Holy cow. That's almost double than what I could if I just did the employee deferral and profit sharing. Is that serious? Is this guy legit? Is that right? It is. It's a hidden gem. And unfortunately, not enough people know about it. Just add that to the list of another thing that mainstream America is not educated about. And imagine doing this for 10 years, 58 versus the 31.5. How much more money in 10 years you will have if you do the backdoor. Now, listen, if you want pre-tax deductions, the backdoor Roth 401k mega backdoor is not going to help you because it's after tax. It's not going to give you tax deductions. But if you're a Roth lover like me, then it's freaking nirvana. It's heaven. It's crazy. So you can't do it if you work at a large corporation. Why? Because in order for you to do a backdoor Roth, you're going to have to pass top-heavy tests, anti-discrimination tests, which you're not going to pass in a large corp unless 50, 60% of the employees did this, which just never happened. So that's why the solo is so valuable. Another reason why the solo K is so awesome is because you can do this backdoor Roth 401k and supercharge your retirement in Roth. And it's so sad that people aren't educated about this stuff. I mean, just imagine how many people are putting in 19.5 plus maybe another few $1,000 and have the capacity to put that 58 away dollar for dollar, but have no idea. And unfortunately, not all solo plans have it. If you get a free plan through Fidelity, E-Trade, Schwab, they're not going to let you do this. They're also not going to let you do alternative assets. They're also not going to give you a Roth feature. They're also not going to let you do a loan. Can't blame them giving you a free plan. They want you to take your money and invest with them. Can't blame them. The way it works, they want to make money. They have every right to do that. We got a different business model. I don't sell products. I'm not out here selling you anything. Okay? I'm trying to educate all of you about what you can do with your retirement. Yeah, obviously, it's in my interest if you do alternative assets, but I think we all realize that diversification is important anyways. So I'm not selling you, hey, go buy real estate. People say, oh, you're such a big Bitcoin guy, you push Bitcoin. No, I'm just telling you what you can do, something that I've done. I don't care what you invest in. All I'm telling you is it's your money. Don't let a financial advisor tell you what you can do. If you want to do something, you have every right to do it. The tax code lets you do this. It's in the code. If the IRS didn't want you to do alternative assets or real estate, guess what? They would just say you can't do it. But they understand the power of diversification. They understand that people tend to do better when they invest in assets they know and trust, assets they respect, assets in some cases they can touch, like real estate. So again, I don't care what you guys do. I want to educate you. If you do alternative assets, of course, you need to use IRA Financial. We're the best for a reason. We care. I care about every single one of my clients. Any one of you emails me, I will respond to you. Okay? I don't care who you are. You don't even have to be a client. If you have a good question, I will respond to you because that's something I totally care about, and I want to help all of you get rich. The only thing I ask about is when you hit 72 and you got $1 million, send me a nice bottle of wine. That's all I want. Nothing makes me happier when I talk to clients and I say, Adam, I've been with you 7 years, started with X. I've made 7-8 times my money. I'm so happy. Thank you. And I'm just like, oh, that is like magic to my ears. I love that. Nothing makes me happier. I would love every one of my clients to have $1 million plus a retirement. And it's possible, right? It's possible. Just need to educate people. Okay, I've kind of got sidetracked. Sorry about that. I got a lot of questions. I got about, I don't know, 10 or so minutes left. Let me go to some of these emails because I don't want to ignore all my all these emails I got. Let me just pick the good ones though. What are the rollover rules for a Roth IRA? Okay, that's a good one. A Roth IRA cannot be rolled into anything. You can't roll a Roth IRA into a Roth 401k for some reason. Don't ask me why. Makes no sense, but you can't do it. So once you're Roth, you're stuck in Roth. Okay, you can't even unconvert. You're stuck. So just remember, when you go Roth, you're stuck into Roth. Let's see. Can I roll over a traditional IRA? I have to an inherited IRA. No. Inherited IRAs also can't be rolled over to Roth. Once you inherit an IRA from a non-spouse, if you inherit an IRA from a spouse, you can move that into your own IRA. But if you inherited an IRA from a non-spouse, it's stuck in a what's called a non-spousal inherited IRA, and you technically, under the new Secure Act rules, are required to pull that money out over 10 years. No more stretch IRA. So that's a good question. Oh, Joe wants to know, how many rollovers am I allowed to do each year? Well, if you do a direct rollover, that means when you go IRA to IRA or 401k to IRA or IRA to 401k, that's unlimited. You can do that 1,000 times a year, 1,000,000 times a year. If you do an indirect rollover, which means the retirement account goes to you first and then goes to another IRA, that can only be done once every 12 months, okay? And you have 60 days to do something with that money. So if you pull, let's say you're over 60, you got a 401k, you pulled 80 grand out, okay? You wanted to do a deal, buy Bitcoin, whatever. In 60 days, you got to put that money back into another retirement account. If you don't, it's subject to tax and a 10% penalty if you're under the age of 59 and a half. Now, if you pull cash out, you got to put cash back in. I got this question yesterday. Someone bought Bitcoin, did really well because in 60 days, price of Bitcoin jumped. And now they're like, Adam, what do I do? I got all these Bitcoin gains. Can I just contribute the Bitcoin back into an IRA? I was like, no, buddy. You got to sell the Bitcoin. Probably going to pay tax, short-term capital gains tax. And then you got to roll that cash back in to an IRA or 401k. But whatever you roll out, you got to roll in. So if you took 60 out, you got to put 60 back in. You can't put 100 back in. If you put 40 back in, you're going to be subject to tax on the difference. One other caveat. If you do an indirect, again, once every 12 months, in the aggregate for all IRAs or all 401ks, okay? If you have 15 IRAs, you can't do it 15 times. It's one for all your IRAs. And if you do it from a 401k, you're probably going to get slapped with a 20% withholding. Now, they're basically just taking out 20% to help you pay the tax. If you don't want that 20% withheld, you have the ability to put the 20% back in within 60 days. So let's say you pulled out 60K, 20% is 12K, and you're like, I need that money. You can put 12,000 back in from your pocket to cover that withholding. So that's something to just be an FYI on. I have an LLC solely owned by my solo 401k out, disregard entity. Does the solo K have to file a tax return? No. Single member LLCs do not file tax returns. Only partnerships. Only LLCs with 2 or more partners. Single member LLC, disregard entity, no tax return. You may have to pay or file annual franchise fees, whether you're in California, Texas, Florida, for example, has an annual fee to pay $138 or so, but there's no tax return, okay? Why? Because generally, if you had a single member LLC, in most cases, it's owned by you, right? And you're going to file a Schedule C, it's going to be under 1040. It's a little bit interesting because you have a situation where you have an LLC owned by a retirement account that doesn't pay tax. So you're dealing with a situation where there's no tax return ever filed. So there are instances where you will get a letter, and I've seen it. And why? Because your LLC gets a 1099, and you get a letter and say, hey, Adam, I see you are involved with XYC LLC. You got a 1099 for 50K. Why didn't you report it? It happens, and all you do is report back that, hey, the LLC is owned by an IRA. If we're your trust company, will write a letter on your behalf. You can attach it, certifying that the IRA owns the LLC, and then it goes away. So not really a big deal, but that can happen. If my IRA was started 10 years ago, let's use 100K as an example, and I invested 50% into stocks and did well, let's say doubled, and the total IRA is now 150. If you trade stocks, you require a new, faster, complex. I'm not sure I got that question. So anyways, maybe what you're trying to get to is if you start with 100K and you go to 150K, if you want to take a distribution, you pay tax on the value you pull out. Doesn't matter your basis. Doesn't matter what you start with, right? It's matter what you pull out, right? There's no tax. Doesn't deal with holding periods. Don't have to deal with situations of basis, what you pay for it. It's all about what the fair market value is. Now, if you got a Roth, you don't really care because whatever you pull out, so long as you're over 59 and a half, Roth's been open 5 years, is tax-free. So if you're talking about, you want to take a distribution, you did well in the stock market, whatever you pull out, subject to tax, under 59 and a half, 10% penalty. Oh, got a lot more questions. How does someone email you? You can email me. You can email me at info@irafinancial.com and just say for Adam, and someone will send it to me. Info@IRA Financial. You can also ask a question on our YouTube channel, IRA Financial. You're on it, so you know how to get to it. Also, find us on Facebook, Instagram, Twitter, and we're always available to answer questions. In fact, that's pretty much what I spend most of my day on is kind of doing blogs, writing articles for Forbes, videos, answering questions. I'm actually on my 9th book, writing. That's how I spend my days. I love thinking about new wrinkles, new ideas, new ways people can use their retirement money. I've been writing a lot on NFTs, fungible tokens. I'm writing an article for Forbes on that. I just did a blog on that, whether it's collectible or not. And obviously there's some interest in digital assets, NFTs, probably a collectible, especially if you're dealing with art. But there's some interesting arguments both ways, especially if you look at how the tax code describes what the IRS could potentially prescribe as a future collectible, talks about and references the word tangible, which an NFT is not tangible. It's a digital asset, right? It's a digital deed, let's say, of a digital piece of art or digital basketball image or highlight or whatever it is. So it's interesting. It's something that we'll see a lot more interested in. How do you follow blogs? Go to IRA Financial Group. Also, we send out newsletters, but if you go on our website, you can check out our blogs daily. We post every day. I also post 3 podcasts, Ad Mail, Ad Bits, and Adam Talks, generally Tuesday, Wednesday, Thursdays each week. So you can pick those up on Apple, SoundCloud, Spotify. Just subscribe and you'll get notified when we drop a new pod or when I drop a video. So if you have video requests, you have certain subjects you want me to discuss, just let me know. I'm here to help. Honestly, I'm at your disposal. I want to help you guys. I want to get you guys focused on retirement. This is game changing. This is not just for you. This is potentially for your family. Okay. I've seen it. Trust me. I've been doing this. I've seen it with friends. I've seen it with family. You guys can leave. Imagine the feeling being in your 60s or 70s and knowing you got $1 million+ in your retirement account. And hey, I'm a pretty basic guy, not super crazy. Like, not going to have to go through all my money. I have other savings. Just to know that, hey, this money's for my family. So like whatever happens in my life, I'm going to leave a legacy to my spouse, my kids, to their kids even. It's a beautiful thing. It's not a get rich quick thing. And that's why I don't have 5 million subscribers on YouTube. I wish I did. If I told people, hey, do this one thing and you'll have $1 million tomorrow. Yeah, I'd have 10 million subs on YouTube, right? But I'm realistic. This is a process. Nothing worthwhile is quick. Got to work at it. The good news is it's fun. And the good news is it works without much involvement. As long as you just make contributions, you invest in what you believe in, you diversify, and you trust the process, and you just have patience, I promise you, you will have serious, significant wealth. Okay. I keep going through this. It's true, but it's going to take time, right? Imagine you're 27. Okay. Imagine you could put in $5,000 a day. I wish. $5,000 a Roth in a year, 27 to 72. Assume an 8% rate of return, which you can get over 45 years. So we're $2 million. Okay, yeah, time value of money, $2 million in 45 years may not be worth what it is today. I'll take $2 million. If you told me 45 years ago, I was born in 1975, that I'll have $2 million in 2021, guess what? That's still real money. Yeah, $2 million was worth more in 1975. It's still worth a lot today. I can still buy a really nice house, right? Really, really nice stuff for $2 million bucks. I can live off $2 million for probably the rest of my life. So it's still money. And it's there. You'll be so happy in 20, 30 years when you're looking back and saying, or talking to your friends and saying, I'm retiring. Like, I'm playing golf, I'm traveling, like, I'm done with work. I'm 65, like, do some consulting stuff. I'm done worrying. And your friends are like, what do you mean? You have such a high lifestyle. How the hell can you afford it? I'm like, well, I started saving when I was in my 30s and I got 7 figures plus, and I'm good. And it's harder to make up for lost time. If you start saving at 25 and stop at 35 versus if you go from 35 to 50, you'll have more money at 25 to 35 than if you go 35 on till 65. Why? Deferral, compounded return. Your money grows faster over time. So again, it takes time, and I'll be there with you guys. Hopefully I'm 45. Like, I'll be doing this 35, 40 more years. Hopefully I can stand. I want to see all of you with 7 figures. I'm going to be there. I know it because I see where I'm going. And again, you don't have to buy. I don't care if you buy stocks or ETFs or mutual funds. I really couldn't care less. You don't have to use IRA Financial. But I want you to be rich. The wealth divide is too big here. There's no reason we should have such a wealth divide. In fact, I've talked about this, and my next book is really about showing that instead of the government giving everyone earned credits for kids or certain people over or under a certain income threshold, what they should really do is give certain people just money in a Roth IRA that they can't touch till 59 and a half. So let's say you make less than 50,000 bucks. We're going to put in every year X amount of dollars instead of an earned credit that will reduce your taxable income. Who cares about a tax deduction when you make 40 grand? Big deal. You're not paying that much tax anyways. We're going to put that in a Roth IRA. We're not going to let you touch it till 59 and a half. We'll invest it in various things for you. And at 59 and a half, you're going to have $400,000 or 500,000 bucks. That will bridge the wealth gap. That will help the lower class move up. It won't impact the middle to upper class, but it's going to help the lower class. It won't be a burden. It's not going to impact businesses. You're not going to deal with issues of $15 minimum wage. It's just going to be something that's growing. And that's something that's very doable. And we can all do it and help out our fellow Americans so we all can have a really good life. The retirement system can do it because it's based off math and it works. And that's just the magic. So I don't think I'm going to have, I'm probably going to sign off. I've done about 53 minutes. My voice is kind of killing me. But I really appreciate you guys for sticking with me. Definitely just subscribe. I promise I'll pump really good content out for you guys. If you have questions, info@irafinancial.com. Hit us up on YouTube, Facebook, Instagram, Twitter. I'm here for you guys. Just want to grow our self-directed retirement nation. I should have 1 million subs, right? There should be 53 million people in IRA. You would think there should be 10 million people doing this stuff, right? Especially now when you can get into Bitcoin for like 500 bucks. Like, I always say, like, we're doing great setting up approximately 1,000 accounts a month. Like, we should be doing better. I should be doing 10,000 accounts a month. So it's my job to educate people that, hey, you can do this. You can take control. You have the power. I didn't know about this stuff. I'll end on this. Like, I was a tax lawyer at some of the biggest law firms in the country. Like, I have a master's in tax law. I've worked with some of the smartest people in the freaking world. And I had no idea that you can use your IRA or 401k to buy real estate. No idea. If you told me that 15 years ago, 20 years ago, I would have said, well, that's impossible. You got to buy stocks. You got to buy mutual funds. So if I, as a tax attorney, someone who studied tax law, someone who actually did an extra year and got a master's in taxation, someone who worked at some of the largest law firms in the country, if not the world, if I didn't know about it, how the heck do I expect people that are busy with their life, trying to make a living, trying to make more money, take care of their families, how the heck are they supposed to? So that's my passion. At the end of the day, that's what I hope, that I educate more, even if one more person a day, understanding, hey, I should be putting money in an IRA or Roth IRA. Instead of saving and investing through Robinhood, I should do it in a Roth IRA. All my money's tax-free. I should try to push more money into a 401k. If I'm getting potentially free money with a 4% match from a 401k employer, I should put more money in the 401k. Maybe I should save an extra $10 a week. Small little things add up over time, right? It's like the 10,000 hour Malcolm Gladwell theory, right? If you look at it one day at a time, it's like you're not making progress. But over 5 years, 10,000 hours, like bang, you're an expert in any field. It's kind of like that with a retirement account. Every day you're doing it, you're like, $5 a day, what the hell does that matter? But 5-7 years later, you're like, oh my God, like I have 60, 70,000 bucks already. You hit that tipping point and you're like, wow, this is good. So you can do it. All of you can do it. We'll do it together. Keep listening, keep watching. I'll be here with you guys. I'm here to help. So thanks again for being awesome. Let's get a million people on my YouTube channel. Let's get a million people exploring self-directed retirement accounts. Let's get a million people passionate about their future, about generating real significant wealth for their family. We can all do it, and we're going to do it. So thanks again. Stay safe, stay healthy, and I'll talk to everyone again in another Ask Adam, I'd say in April sometime. So hopefully by then, you guys will be more passionate. We'll all be in a better place. We're getting to the end of COVID. So got a lot of good things ahead. So take care and talk to everyone again soon. Cheers.